2023 has been a wild year thus far for investors and economists alike. With inflation hitting record highs in decades, the Federal Reserve has been implementing quantitative tightening by raising interest rates and thus slowing down the economy and diminishing asset prices. The present environment therefore presents us with an exceptional opportunity to get in on compounding assets at attractive prices. Today, we're revealing the top 8 compounding assets you should consider for 2023. Stay tuned until the end of the video, where I reveal the potential highest ROI asset on this list. If you want to dive even deeper into the world of finance, check out the list of game-changing books in the description below. It's helped me achieve financial freedom, and I'm sure it will help you too. Click any of the links below to grab your copy. The magic of compounding. Compounding is a simple yet magical concept. Think of it as a money-growing tree. With compounding, you're not just earning money on the amount you put in, but also on the returns that your money makes. That means your money is making its own money. The key here is time. The longer your money can compound, the more it grows. It's not a get-rich-quick trick, but a slow and steady wealth-building strategy. Now, let's explore the best compounding assets you can invest in for 2023. Number 1. Rental property. Rental properties are one of the best compounding assets over the long run, as you not only get in on the appreciation, but also receive passive income through rental income. With rental properties, your tenant essentially pays your mortgage. Each month, as you collect rent and pay your mortgage, you're building equity in the property. You're steadily owning more of the asset while someone else pays for it. If purchased right, you might even have a good amount of income left after you pay the mortgage. Then there's the magic of appreciation. Over time, properties usually grow in value. This means that your $200,000 property today could be worth a lot more in the next decade. Since debt is very easy to acquire in real estate via mortgages, it can magnify the compounding effect. For instance, if you put a down payment of $200,000 on a $1 million house and the property appreciates a mere 20%, you've already doubled your money. Number 2. Index funds. So what are index funds? They're like a mirror that reflects a particular stock market index. When you invest in an index fund, you're investing in a bunch of companies at once. Your money is spread across all the companies that make up that index. Sounds like a pretty smart way to spread your eggs across many baskets, right? The beauty of index funds is they ride the wave of the economy. If the economy grows, your investment grows with it. Research shows that by and large, index funds are the best risk-adjusted investment for most people, especially if you are younger. You might want to consider S&P 500 index funds, total market index funds, or NASDAQ-based index funds, including ticker symbols VOO, VTI, and QQQ. Because index funds involve minimal management, they often have lower fees compared to actively managed funds. This means more of your money stays invested and has the potential to grow. Besides, index funds tend to outperform actively managed funds over a long period of time. Vanguard funds in particular have lower fees. If you're enjoying the video so far, be sure to like and subscribe. Number 3. Cryptocurrency. Cryptocurrencies are digital currencies that use cryptography for security. The most famous of them all is Bitcoin, but there are thousands of others, each with their unique characteristics and uses. One of the reasons why people invest in cryptocurrencies is the possibility of high returns. It's been known to make some people overnight millionaires. But remember, where there's high reward, there's high risk. The value of cryptocurrencies can be extremely volatile. It can skyrocket one day and plunge the next. Last year, crypto saw a steep decline of over 70%. This year, we've seen a slight recovery, albeit a mild one. While still highly volatile, widespread adoption and integration of blockchain technology can drive demand for cryptocurrencies. Second, the finite supply of many cryptocurrencies, along with economic instability or hyperinflation in traditional economies, may lead investors to turn to cryptocurrencies as a safe haven, thereby driving up their value. If so, crypto could become a long-term compounding cash cow. Number 4. Certificates of deposit. A CD is a type of savings account that has a fixed interest rate and a fixed withdrawal date, known as the maturity date. It's like planting a money tree that you agree not to harvest until a specific date, and in return, it gives you more fruits in the form of interest. What makes CDs so attractive is the predictability they offer. You know exactly how much you're going to get and when you're going to get it. There are no nasty surprises. Even better, the FDIC insures any amount put into CDs for up to $250,000. But there's a catch. You need to leave your money in the CD for the agreed term. If you withdraw early, you'll have to pay a penalty. Number 5. Bonds. In the simplest terms, a bond is a loan that you give to a government or a corporation. You're basically playing the role of a bank. Instead of getting a loan, you're giving one. And just like a bank, you get paid interest in return. But why do governments and companies borrow money from regular folks like you and me? Well, they need funds for various projects like building roads or expanding business operations, and they're willing to pay interest to those who help them finance these projects. The risk with bonds depends on who's borrowing your money. Government bonds are generally safer than corporate bonds because it's less likely for a government to default on its loan. But remember, higher risk can lead to higher returns. With interest rates high, bond prices have come down in 2023. As such, now could be a great time to invest in bonds. Number 6. Precious metals. For centuries, humans have been fascinated by gold, silver, and more recently, metals like uranium and copper. These aren't just shiny trinkets, but valuable resources that play a significant role in the economy. Gold and silver are often considered safe haven assets. When the financial markets get rough, investors often flock to these metals as a refuge. It's like having a storm shelter when the financial weather turns nasty. But it's not just about safety. Precious metals like gold and silver are also known for their ability to hedge against inflation. When the cost of living goes up, so often does the price of these metals. It's like having an inflation-proof shield. Then we have uranium and copper. They play a crucial role in modern technology. Uranium powers our nuclear plants, while copper is essential for electronics and electric cars. As demand for these technologies grows, especially with worldwide movement toward carbon neutrality and increases in electric cars, so could the value of these metals. Investing in precious metals can be done in various ways. You could buy physical gold or silver bars, invest in mining companies, or even buy exchange-traded funds, ETFs, that track the price of these metals. Number 7. Private equity real estate funds. Private equity real estate funds are essentially a collective investment scheme. It's like forming a team where each player brings their money to the table. This pooled money is then used to invest in real estate, which could range from residential properties to commercial buildings or even large development projects. The charm of this investment approach lies in the power of collective buying. It lets you get a piece of property that you might not be able to afford individually. It's like joining hands with others to buy a luxury car, instead of settling for a regular one on your own. But it's not just about being able to invest in bigger properties. These funds are managed by professionals who know the ins and outs of real estate investing. They do the hard work of finding promising properties, managing them, and eventually selling them for profit. Websites like Cadre, CrowdStreet, and Fundrise now make it easier for retail investors to get started. Number 8. Investing in startups/private businesses. It's time we turn our attention to the vibrant world of startups and private businesses. With platforms like YieldStreet and Angel Invest, everyday investors now have the chance to nurture tomorrow's potential giants. Investing in startups or private businesses means putting your money in young companies that show great potential. It's like nurturing a seedling that could grow into a mighty tree. These are companies that aim to disrupt industries, bring innovation, or introduce new ways of doing things. Imagine getting in at the ground floor on companies such as Uber, Meta, or Amazon. That's exactly what you are trying to do with startup investing. The attraction of investing in these young companies is the potential for high returns. If the startup succeeds and grows, your investment could multiply many times over. But with potential returns come high risks. Many startups don't make it past the early stages, and unlike publicly traded companies, information about private companies can be harder to come by, making it more challenging to assess the investment. But as Peter Thiel mentions in his book, 0 to 1, get your copy in the link below, if you wisely invest in a large basket of startups, one winner will cover the losses of every other company many times over. If you're the type of investor who likes to be at the forefront of innovation and doesn't mind taking on some risk for potentially high rewards, this could be an exciting opportunity. You're not just investing in a company, you're investing in an idea, a vision, and the people who are working to make it a reality. And there you have it, the top 8 compounding assets to accelerate your wealth growth in 2023. If you'd like to learn more about saving money to invest more, click on the video on the screen. Until next time, keep calm and compound on.